Hello there everyone, Steve Chappell here at VectorVest. Today we're going to be talking about the ins and outs of Contra ETFs, and boy do I have a hopefully wonderful presentation in store for everyone that'll really open your eyes to some significant potential that these Contra ETFs provide to us in market declines. And it's all going to begin with a story, a date and time that I'll simply never forget. And that's when Dr. DeLito and I, were at a AAI investor conference in Orlando, Florida back in 2007. It was November of that year. And to paint the picture, let me take you to a market timing graph. It was November the 1st and 2nd. And we were telling everybody we could that Contra ETFs are going to be the big story for the coming year. And I'm very proud to say our company was, I think, one of the very first and foremost companies to really educate our investors on the benefits of Contra ETFs and how they can really help you, in particular in significant market declines, bear market kind of indications. And so just look at the graph. Here we are standing in a booth talking to anybody who would listen about Contra ETFs on the back of a 5-year bull market where everything you bought just went up. You know, those guys and gals were looking at us like we were on the moon or something, and they just couldn't believe it. But lo and behold, we went back to that AAI conference a couple years later, and we had a bunch of subscribers wanting to sign up for the service. You know it, because let me show you what Contra ETFs can do for you. Then we'll get into the discussion of exactly what they are, how to use them and why, and so on and so forth. But just remember this date, November 2nd, 2007. I'm going to take us over into the searching capability of VectorVest, the Unisearch tool, and we have this folder called ETFs. And in there, you're going to have searches to find Contras. And so one of them that we really like, if you're up to speed on leverage, which we're going to talk about more here in a bit, this can be a really, really good search. And so when we run it, what we're finding here at the top of the list are a bunch of symbols of exchange traded funds that are inverse to the benchmark market that they represent. Again, more on that here in a bit. What I want to show first is the potential, then we'll talk about the what and the why and the how. All right, so I'm going to just do a quick test here of the top 10, and we're going to take it from that market peak back in November 2nd, 2007, all the way up to the market bottom, March 9th, 2009, and look at the performance of these instruments over that period of time. So while the S&P 500 fell more than 55%, these instruments climbed more than 80, indicating some of these do in fact carry leverage. So we'll talk about that. But isn't that something? You know, instead of what's the general guidance, buy a little bit of the S&P 500 every month? Well, over the course of 20 or 30 years, that tends to be some pretty good guidance. However, there's a lot of money to be made when markets are in retreat. Stock markets fall faster than they rise. And so you're missing out on all of this potential when you do things like that. Then you have the opportunity to bottom fish, make hundreds of % on the way up, and rinse and repeat over and over and over again across time. And just to prove it to you, if I go to the VectorVest views and we go back to 2007 and then on, we had a confirmed down call, one of the first couple of days of that conference. And then it was the Friday where he said, boy, I'm going to write about it this weekend. We're going to write about those Contras and get everybody up to speed, Steve. If I scroll down here a bit, that essay that week was titled Contra ETFs. So we started writing about it in a big way back in November of 2007. That's a long time ago. And boy, lots of great information in this essay, but I'm going to skip down to what I think was the most powerful paragraph in the whole thing. And it said here, A word to new subscribers. The confirmed down signal that we received yesterday could be the entree to a long bear market. We aren't there yet because earnings are still rising according to our method of analysis. Yet we no longer appear to have the support of an accommodative Fed, and that can make things very bad for the stock market. So don't be deceived by the endless parade of experts who will appear on TV and other places telling you to buy stocks. This is not the time to buy stocks. And my friends, we'll see, but we are working our way towards some of this strong language contained right in that paragraph right now. The Fed is certainly turned the corner from dovish to hawkish, and it's long been the cycle that the Fed will inevitably overshoot and create the next bear market scenario. The question, of course, is just when. And don't worry, we'll be there to tell you. But any market downturn with substance, Contra ETFs can really benefit you in a big way. So we're going to be laying all that out in this webcast. Let's get to it. So let's start with what are Contra ETFs? Contra, or inverse, you might hear them called, ETFs are exchange-traded funds that use short-selling derivatives, futures, or other leveraging techniques to produce returns that are inverse of a market benchmark. Typically an index, but boy, seems like hundreds, if not thousands of these, and they've even gone into sectors like biotech and petroleum and, you name it, oil. Instead of petroleum there, but you get the point. I mean, it could be on market indices like the S&P, the Russell, so on, or even down to a sector level at this stage. So how do they work? The goal of that ETF fund manager is to achieve daily returns that are opposite or inverse of a benchmark index, such as the S&P 500, for example, or any other assigned benchmark. So the goal of the fund manager, if they're doing an inverse fund, is when that benchmark is falling, they're going to use those short positions or derivatives to try to push an equivalent percentage higher on the fund. So if the fund falls 1 point, they're trying to gain a point higher. That's the inverse. They also can contain leverage, and that's where it gets really interesting, and maybe treacherous if you're not careful. We'll talk about that. Many of the funds carry an additional leverage, so 2 or even 3 times the inverse to that assigned benchmark. All right, so cool. I can make money when markets are going down, and I can even leverage that capital. Yeah, and you can even leverage it even more with the use of options. But where can I find them? That becomes the pivotal question. Well, I've already given away one spot you can find them, and that's in the Unisearch tool. But there are others, and I think a good set of other places to find them where we can benefit from taking the time to show you. So what I'm going to do, get us over into VectorVest and really spend some time shaking down ETFs, in this case Contras, helping you identify what you're dealing with and then showing you some more performance so you feel comfortable in knowing what you're doing. So let's get to that. All right, so here we are back in VectorVest. What I'm going to do next is go right up here to the Viewers tab. On the Viewers tab, I'm over here on the left in Watchlist Viewer. Okay, so in Watchlist Viewer, you're going to have an ETF folder. And in that ETF folder, I've selected Contra ETFs. So here's where you can find them. Now, this is the entire listing. So this is going to have the single, the double, the triple leverage funds, all enclosed in one capsule. You're going to see here in a minute where we can segregate them into different leverages or even just indices, which can be a major benefit for those that are brand new. What I've done is at the top of the list today at 11:33 a.m. on Friday, I've just hand selected one here for benefit of demonstration purposes. This one here is a single levered inverse fund for the S&P 500. It's called SH. Now, how I got to my listing here, which may differ from yours when you first get in, is I have a habit, and this is a habit developed from that very same set of days back in 2007. Because really back then, almost every Contra ETF that wasn't representative of a market had very little to no volume. So we got people in the habit of coming over here, sorting by average volume to get the major indices or the very liquid Contra ETFs to the top. Usually in the past, that was only the major indices. Now things like volatility, because of the juice that one can create, have become quite popular as well. There you go, a derivative of a derivative, right? But let's go back over to the left, and that's how I got here. So now when I right-click on this and pull up a stock graph, let's start there. First thing we'll see, maybe not as obvious to everyone, but certainly obvious to me, is that this exchange-traded fund, which represents a basket of things that are inverse to S&P 500 declines, it thrives and goes up when markets retreat. And it retreats when markets go up. So that's that inverse relationship. To show it a little better, what I'm going to use, and I'm happy to do this because we don't use it very often, is use a performance graph. So you can come up to the top left corner and select performance. In here, what I'm going to do is show you this inverse fund in relation to its benchmark, which is the SPX, the S&P 500. When I do that and click it on, here you can see that relationship. So the S&P is blue. So when the S&P is falling, what's happening with the inverse fund? It's rising in direct correlation to the fall, symmetrically. When the S&P rises, what happens to the fund? It falls, right? So just knowing what we know now, when are the best opportune times to use an instrument like this to try to make money in a falling market? So that's all we need to know for now. Just to put one little thing to rest, if I come in here and add the VVC and take off the inverse fund, look, we use VectorVest Composite because it's all you need. So when we get into the market timing graph, just know the S&P, the NASDAQ, the Russell, they all essentially move together, certainly over a period of time. Okay, so while you might tune into CNBC and on any given day, one's slightly outperforming the other, the magnitudes are different. One might be up, one down. Overall, they all move the same way. You could simply add things to your liking. IXIC. Oops. And just keep adding them to your heart's content. And then it's really, again, just the magnitude in terms of differences. They all move in the same shape, and that's what matters. We need to get direction right. We get direction right, then we get in the funds that are outperforming the others, and boy, you really got a recipe for success. All right, so let me go ahead and close out of this. And now that we got all of that good groundwork behind us, just a couple of things to open your eyes. So over here on the left, let's say I'm brand new to this whole concept. I got it, Steve. I understand the basics now. Inverse funds go up when markets they represent go down. But this whole leverage thing, that means things are really good when they're good, right? But they're also probably really bad when they're working against you. That's exactly right. And so that's why I would say when you first start to use these things, stick to the non-leveraged funds. So we do have a couple of different ways to get there, and I'm going to show you one that I think works really well when you're brand new. So first things first, I come down towards the bottom here. You have index ETFs. We're going to come back to that one. So that's only going to be indices. You also have non-leveraged ETFs contra. So here again, you can get even down into the sector, industry group type bracketing of these funds. Okay. So if I click on that one, now I know that I'm not dealing with 2 and 3 time leveraged funds. All right. I can also pay most attention, if I like, to just the indices. And I think this is a wonderful place to start for those that are brandy new, because we're timing the stock market. Now it's true, the individual market segments should follow suit, but if you're not careful and don't know what you're doing, you might end up in oil or something that's completely different, can have completely different connotation. So let's focus when we're new to the index contras. Now when we do this, there is still going to be some leveraging in here. But when we get direction right, it's really going to work to our benefit. Okay, so a couple of things. One would be, let's look at some performance. But before we get there, slide out to the right. And one thing I'm always in the habit of doing, see this one here at the top? Chad, it's only got 25,000. It's probably on a little bit more of the esoteric side of things. When I click on average volume, now I've got the SQQQ, the SH, the PSQ, and the SPX. All of these are inverse to the indices that they represent. So if I don't know what one is, let's say SQQQ, well, what the heck is that? It probably has to do with the NASDAQ because I see 3 Qs in there, and the S probably means short, but let's make sure. I can right click, and then I can go to View Full Stock Analysis Report. All right, so when I do that, sure enough, right here with the business description at the top, it tells me that this is an exchange-traded fund incorporated in the USA. The fund seeks investment results which correspond to 3 times the inverse. So for every point, say, that the NASDAQ falls, this fund manager is shooting for 3 points of gain, which is really good when you get it right, but can work against you pretty quickly if you get it wrong. So timing is going to be critical with these types of funds. Again, if I go to the next one, right click on SH, View Full Stock Analysis Report. Here you won't see any of the 200 or 300%. This is just inverse the opposite. That's a one-time single levered fund. It's just directly opposite the index itself, no leveraging. It says an exchange-traded fund incorporated in the USA. The fund seeks daily investment results that correspond to just the inverse of the daily performance. So I can make some decisions on what I want to do. I can take things that are non-levered, and I can do so for the S&P, the NASDAQ, the Dow, even the Russell with the RWM. Those would be your 4 major indices. Or I can add leverage. I can do triple leverage the Dow, triple leverage the NASDAQ, triple leverage the Russell, triple leverage the S&P. I can do either one, okay? Or, I could buy them all if I wanted. Just got to be right, and maybe reduce, get that 2 to 3 time lever more like around back 2 again, maybe a little less. Right? But anyway, let's move on then to really showing you some more performance more currently. Okay, so I could do this ad nauseum for the last 25 years. I want that to be clear. Some work out far better than others, right? But vast preponderance of the time, you're going to be handsomely rewarded, particularly when we get into bear market scenarios. All right, so what I'm going to do then is jump back into the market timing graph, and we're just going to deal with the last year. Really going back to about November of the prior year, November of 21. So here we have a market that came up, peaked, and then really began to fall off. And so if we zoom in around here, we peaked on 11.9. So what are some things in VectorVest that can aid me in identifying opportunities to use these instruments? That's going to really depend somewhat on your investment temperament and your style. For example, some traders might begin to really lick their chops as the market begins to pivot down and away from just the high point. Others of us, more prudent to conservative, are going to wait for maybe an oldie but a goodie, say a confirm down call. So we made some wonderful early calls in the VectorVest views that we can elaborate on. We also had earlier indications like a DEW or a primary wave down if we're more aggressive. But let's start just at square one with the confirm down. So if I stretch this across, that confirm down, had we listened, gotten defensive, I believe Angie's talking about protecting profits in this week's essay. Had we protected profits and then rolled capital into these contra funds, could it have been beneficial to us? So here's down signal, stretch it out a little more, to up signal. Okay, so what if we just would have bought some of the main non-levered market indices, inverse funds, and went call to call, signal to signal. So we're going to go from 1122 to 329. 1122 to 329. So we go back over to our list, and we'll start with the non-levered. And we'll quick test these, but we got to change our date up here. Actually, I should have done that first. That's okay. There's a lot going on in this presentation. So we'll go back here a bit. There's the down call. All right, so we'll go find a couple of these boogers. All right, there they are, the 4 of them. So we got the S&P, the NASDAQ, the Russell, and the Dow. And we'll just quick test the selected. All the way to now, they're up. Let's take it back. Let's go back to the confirmed up call on 329. All right, doesn't seem like a whole lot here. So let's talk about that a little bit. Now, 2 things already. One, we would have been protecting profits and rolling our money here, which would have been a far better place to be with the S&P lower. Right? And in fact, we would have walked away with gain. Now, let's eliminate this quick test and watch this. So a couple of things. One, as we ultimately get down here and start to really find some flooring, where we're now on our second leg down really, and the buy to sell ratio around this time is going to be coming in down there in that 0.2 zone and below, right? Even back over here. How much potential do we know, being VectorVest subscribers, do we think there is, rather, when the buy-sell ratio gets down to 0.1? When it was well above 1, north of 2, before this downtrend started. Probably not a whole lot left. As far down as it can go, we know to this day, is 0.02. Right? Think you might want to start coming off the gas? Let's see. Let's take it just forward to January 28th. So we'll do the same quick test. Look at that. So 8.69, right? Now you're making about a 47% annualized rate of return when the market is off 5% or 29 annualized at that time. Interesting, right? What do you think? I think this is beginning to resonate that there might be some opportunities here. For example, if we then scratch that and take the leverage, quick test selected, look at that, 26%, 144% annualized, market's only off 5%. Do you think this leverage matters? Let me show you something pretty cool. What if, instead of just going call to call or call to market low, and when we start to bounce and give back more than half of what we've made, walk away with some handsome profits? It's a far cry from where we were in 2007 to 2009, right? Because we're not in the full-blown bear market yet. If and when we get there, those are the kind of results you're going to get now, okay? So I'm helping to kind of put to bed a couple of things, really. They call it a bear market on CNBC. Boy, we have not seen a bear market yet. I can promise you that. Number 2, what if we want to try to kick it up a notch from here? So this would be for the most aggressive of folks that are both A, comfortable with the leverage, and B, willing to take an early stab at things, realizing it's a highly likely event. So let me go back to the market timing graph. And instead of going, I'm noticing I'm already running a little long in the tooth here. So I was going to show multiple turns, but I'm just going to focus in on this one due to time. What if instead of going signal to signal or signal to low from the confirmed down call, VectorVest is better than that, right? We know, I'm going to take the buy to sell ratio off, put the MTI on. We know that when we get up here above 1.5, we start looking for a market top. And you can stretch that back to your heart's content. And you'll see that anytime we get up there, the market at least pulls back typically, if not, there's no really strong push in the stock market until things regroup and start pushing again. There's going to be times where markets are just on a roll, where certainly you can stay elevated there for a good bit of time. But we know that we need to be looking for opportunity when these things occur. And when we hit it right, man, we're gonna be happy. So we need to be careful getting out of the gate here, but not maybe as careful as one might think, because under these circumstances, it's highly likely that there's going to be at least a few good days in front of you when price of the composite rises enough to push our MTI to a level where we're looking for a toppy market, which is 1.5 or north. The higher you go, the more you can't hardly sit on your hands anymore. And when we look at where we are now, that's precisely, we're coming off of 168, much higher than even where we were at this peak back here in last November. So we're very much in that situation now. I want to make that clear. However, if I come back in here, instead of use the confirm calls, we're going to put on the primary wave. So when you're up in that zone north of 1.5 and you start to see primary waves down, we know one thing for sure. It's good time to be writing covered calls and generating capital, because at this point, when you get up here, downside risk outweighs upside potential. There might be some upside left, okay? But the juiciest parts of the rally are gone. They're gone. Yeah, you might see on occasion here and there a market continue to roll up higher for 3 months. Let me tell you, the performance over that 3 months is nowhere near as good as the prior 9 months getting there. It's not even close. So don't be saying that, in the social medias. Look, we're looking to hit some big home runs here from time to time with what we're talking about now. All right, so when the primary wave turns down and you get confirmation the following day. Okay, so we have a primary wave down call here on November the 10th. What were we saying in the VectorVest views on November the 10th? Now this is of 2021. Higher than expected consumer price inflation data sent the U.S. stock markets to a lower close. With one red light and a down up, prudent investors should not buy stocks at this time. Aggressive traders should play the market as it develops, but with what? A bias to the downside. So we're getting some bad economic data. We've got a bias to the downside. Okay. All right. Let's see if we can put some of these Contra ETFs to use. Well, if I go back, we didn't get confirmation the following day. Market rallied for a day or two, and then lo and behold, another primary wave down is signaled. Did we get confirmation that next day? No. But how about this time? 11/18/2021. Was there follow through the next day there? Yeah, we broke the lows even. Okay. So what if I run this, take on a basket of those Contra ETFs, even the leverage, and then I also now, from Steve's earlier points in the presentation, realize that when the composites go down fast and far enough that the buy to sell ratio gets to 0.2, and I haven't had a primary up wave in between, or any glimmer that the stock markets were going to reverse against me, what do you think about on some weakness here, maybe 11.2, starting to think about rolling out of some of those, because how much downside is left? Well, I know the answer. I'm hopefully asking a rhetorical question, and you now know the answer as well. If not, I'm going to prove it to you. So Let's look at entering a basket near the close on 11:18, because we would have grabbed the open the following, and exiting 12:2 at the close on good bounce. Okay, so 11:18 to 12:2. Come back over to our list. So we get the benefit of getting in a few days earlier. We'll go back to our leverage. All right, we'll quick test the selected, but this time stopping December 2nd. So let's watch the annualized rates of return here. Bing. That's only that's only 11% in a couple weeks. This is when I love being in front of an audience, you know. But anyway, guys, that's 297% a year type performance. I mean, that's, you know, the market is in free fall. All your neighbors and all your buddies at the cocktail parties you're going to are in panic mode, and here you are printing money. Right? And I could rinse and repeat this process, and sure, there's going to be time or two here, there. You know, if you do this call in, call out, signal in, signal out for the last 25 years, any of the things that we've showed in this video, the times where you get it right are life-changing. So I ran already longer than I anticipated, but I think we showed you how you can best use them. Contra ETFs are inverse to the benchmark they represent. Make sure you know what they represent. You can do that two ways. Sort by the average volume. That's going to push the major indices towards the top. Check the stock analysis report. Make sure you stay broad market basis. Russell, NASDAQ, S&P, Dow. Pick your favorites. I don't care. Those are the major things to remember. The only other major thing, and it's the most major of all, is have signal. You don't have to do the most aggressive of things, even though it looked the best. If you just go signal to signal mindset, don't give back more than half of what you've made once you have a reasonable profit of, say, 10% or more. So whichever happens first, you get a reversal in signal, or you give back more than half. That's a reasonable way. Just basic money management. I'll be frank with you. You almost need just a real direction indicator or just some basic money management rules with these things. You get in there with trailing stops, you're going to have a heck of a time with them, okay? Particularly now. Now, when you get into a full-blown bear market, those things start to work really well again. But hopefully you all get the point. Guys, it's been my pleasure to give you this presentation. Hopefully you found some good, useful information out of what we presented today. That was certainly my intent. And stick with the non-leverage, stick with the broad market indices, stick with the signal, and you'll be in good shape to set yourself up for success. We'll see you again next time here at VectorVest University. See you then.